Thank you for joining me for this discussion on the current state of the public finances. I'm Alice Denby, Deputy Editor of CapX. And it's now been over a decade since Liam Byrne left his infamous note saying that there is no money left. And since then, we've had the worst economic shock for 300 years. We've had levels of borrowing and spending that were completely unimaginable, even in the wake of the financial crash. And this pandemic crisis isn't even over yet. So if there was no money in 2010, where does that leave us today? Joining me to discuss this are Paul Johnson, Director of the Institute for Fiscal Studies and Visiting Economics Professor at UCL, Julian Jessup, an independent economist who's worked at the Treasury, HSBC, Standard Chartered Bank, and he's also been Chief Economist at the Institute of Economic Affairs, and he's also, happy to say, a regular contributor to CapX. And Tom Cockety, Head of Tax and Editorial Director at the Centre for Policy Studies. Gentlemen, welcome.
Thank you.
So, Paul, if we can start with you, could you perhaps just give us a bit of an overview of the challenges we're currently facing and kind of where the recent budget has left us in your view?
Sure. Well, I'll have a go. As you said, we've had the biggest economic shock in 300 years and the deepest economic recession in the whole of that period. Actually, it hasn't felt like that. It hasn't felt like the worst recession, not only in 300 years, it doesn't feel like the worst recession in my lifetime by a very long distance. Compare this with the 1980s, for example. And the reason that it doesn't is because of the huge amount of government spending and support that we've had over this year for the economy, for jobs and for businesses. So the OBR thinks that unemployment might peak at 6.5% now. It's its central forecast. Now, if we get away with that, it will be extraordinary, given the scale of the economic disruption that we've suffered. Unemployment rate was double that, more than double that in the 1980s. So that is a remarkable outcome. But that, of course, has come at huge cost. It's come at the short run of enormous borrowing, biggest in any year outside of the First and Second World Wars in the whole of history. And actually what the budget did is to extend that support significantly into the next financial year, so that borrowing in 2021-22 will be the second highest since the war. And even that on current forecast will outstrip the maximum borrowing during the financial crisis. Where's that going to leave us? Where's it going to take us? Well, in one sense, clearly what we have is more debt than we had when we went into the crisis. So towards 100% of national income. Remember, it was below 40% of national income in 2008. It was up towards 80% of national income pre this crisis, about 100% as we come out. So there's more debt around, but interest rates at historic lows, and we're breaking all sorts of records. Interest rates are the lowest they've ever been since the Bank of England was founded in 1694. I mean, that was the case over the whole of the last decade and is even more the case now. So the cost at the moment of servicing that debt is actually at its lowest in the history of government debt in this country as a fraction of national income. So that makes everything sound fine. There are two, I think, obvious risks. One is associated with what might happen if interest rates rise. And amazingly, over the last decade, every year, as we thought that interest rates couldn't go down any further, they did, interest rates on government debt at least, and that kept on providing government with more money to spend compared with forecasts. It's almost impossible to imagine that they will continue to go down, and at some point they will start to rise, and that makes the cost of the debt much higher, and very quickly as well, given the way that it's structured. And secondly, of course, whatever the level of debt at the moment, the worry, I think the bigger worry is what the level of borrowing might be going forward. So if all we had was a year or two of high levels of debt and then borrowing fell immediately to its pre-crisis levels, then perhaps there wouldn't be too much to worry about. But that's not where we're headed, partly or significantly because the economy is going to be smaller than it was projected to be crisis. And on central scenarios, there's a risk that that level of borrowing will have debt continuing to rise, which is not something that can be managed permanently. The budget had two sets of responses to that. First, pretty chunky tax rises down the line, big increase in corporation tax, due to raise 17 billion a year, probably won't raise that much in the medium run, and increase or reduction in the real value of the personal allowance. Two remarkable U-turns, actually, because those are exactly the two areas where Conservative government was cutting tax over the last decade. But between them, if they happen, a reasonably significant fiscal consolidation. The other part of what was in the budget and in the spending review in the autumn was actually numbers which imply, and I put it no stronger than that, very tight spending over the next several years, essentially significantly lower than was planned back in March 2020, despite the obvious increases in pressures, particularly in health, education, local government, justice, and elsewhere. And I'm genuinely sceptical as to whether that level of public spending as set out in the budget will be delivered. My guess is it will come in higher, implying either higher levels of borrowing or higher levels of tax than were set out in the budget. I can understand why the Chancellor would leave that for now, because the uncertainty around the economic future is huge. And you can see that with the sort of lines, the optimistic and pessimistic scenarios in the OBR report are very, very different from one another, as well as being different from the central scenario. But I do think there is a significant chance that further tightening will be required over the next year or two if the Chancellor's to meet what looked like being his public finance objectives, which appear to be to get debt at least stabilised, if not falling as a fraction of national income, and to be borrowing no more than total levels of government investment. In other words, running a current budget balance into the medium term. My guess is at the moment we're not on track for that, but as I say, huge amounts of uncertainty around that.
Thanks very much for that, Paul. Julian, moving to you, would you like to respond to anything Paul said or give your own view on sort of current situation?
Sure. Well, first of all, I think Paul set the scene really well. So not much to add to what he had to say about where we are now. I am a bit more optimistic, though, about the future. For a start, I'm relatively bullish on economic growth. My own view is that we might get back to pre-COVID levels of economic activity as soon as the third quarter of this year. That's a good 6 months or so earlier than the OBR was anticipating. And I'm also not sure that we're going to see a lot of long-term economic scarring to the economy, and in particular if unemployment remains low, and I actually think it's going to peak below 6%, so not much higher than the 5.1% it is now. As long as we avoid a big spike in unemployment, as I think we will, then there won't be a lot of long-term economic damage. And it's sort of a small silver lining from the pandemic is an opportunity to shake up the economy, to reboot it or to build it back better, whichever way you want to put it. A boost to productivity from an acceleration in trends like more flexible working and increased use of the digital economy generally. So I think that we will recover more quickly than anticipated, but also that there won't be any significant long-term economic scarring. If that's the case, then actually there isn't a big black hole in the public finances that needs to be filled. My gut feeling is actually that the tax increases that were announced earlier this month were unnecessary. At least they weren't immediate, so they weren't holding back the recovery over the next year or so. But I think by the time that the freeze in the personal allowance starts to kick in, and particularly by the time that the increase in corporation tax is scheduled to happen, I think by then we'll realise that those tax increases weren't necessary. I'm not necessarily saying that they will be they will be paused, but what they might do is offset them somewhere else in the tax system. So, for example, revisiting the investment allowances and extending the tax breaks there in the corporation tax system. So, first point to stress, relatively optimistic about the outlook for growth. Secondly, in terms of the risks, I mean, obviously the biggest risk is actually a health risk rather than an economic risk, in that, you know, something goes wrong with the rollout of the vaccines, that we get a third or fourth wave that we, for whatever reason, can't control. But all the evidence seems to be pointing the opposite direction there, that things are going a bit better than expected. Looking at economic risks, I mean, I suppose the obvious one is one of those that Paul touched on, which is that interest rates start to rise very sharply. As it happens, I don't think that's likely. I think, you know, the Bank of England has signaled that it's fairly relaxed about the outlook for inflation. It expects inflation to return to target, but until it's confident it's going to do so on a sustainable basis, it's not going to be looking to raise its own interest rates. And, you know, because of the way that we're financing so much of the government debt, it's those short-term interest rates that matter most. But also, even if interest rates do rise, I think it's vital to understand the circumstances in which they were rising. I think it's most likely to be a combination of stronger economic growth. So, you know, things are recovering more quickly than we anticipated, unemployment is lower, and so on. And also a bit of a pickup in inflation. I personally think in a couple of years of 2 to 3% inflation after a few years where inflation's been below target won't be a bad thing. And actually, if anything, it's good for the public finances. So I think, you know, a 1% increase in interest rates over the next few years, okay, that might cost 20 billion or so in terms of additional debt financing costs, but that'd be more than offset by the boost to the public finances from a stronger economy and from higher inflation. So overall, I'm pretty relaxed on that. Final thing I just want to touch on, though, is the original question: is there any money left? I retweeted the topic here to some of my colleagues and friends on Twitter, and the usual suspects often came back and say, well, there's always money left, because, you know, the government can always print money, or at least the central bank can. And it does seem odd to be talking about, you know, is there any money left when the government has been able to find hundreds of billions fairly easily during the pandemic to pay for the costs. I think 3 quick points back on that. One is that, you know, just because the government can find money to spend doesn't mean it's going to spend it well. You know, the government's track record of picking winners, for example, in industrial policy is terrible. And although there have been some big successes during the pandemics, there have been some failures in terms of spending on things like track and trace so far as well. The second point, it's only really been easy to borrow all this money precisely because the economy has been weak. So there's been a lack of demand for spending. So the private sector's been constrained. It's been saving instead. So there's been a lot of, you know, cheap private savings sloshing around looking for a home. You know, Bank of England has helped that. They've intermediated in the process, but basically interest rates would have been low anyway because the economy has been so weak. And then the final point is that, yes, of course, the government or the central bank can print money, but it can't print the real goods and services that money is then used to buy. So the government still faces real resource constraints. And, you know, as and when the economy gets back to normal, if it were to maintain anywhere near the current levels of spending, it would pay a big price, in particular in terms of higher inflation. So I think the big challenge going ahead is not so much going to be to boost the economy. I think the lifting of the lockdown will do that itself. It's going to be trying to persuade people that the state can and should now step back, and that we can't continue with these high levels of borrowing and debt, not so much because they're hard to finance, but because they distort the economy in all sorts of ways that aren't good for longer term growth and productivity.
Thanks very much, Julian. Tom, would you like to respond to that? Sorry, I think you're muted.
Yes. No, I'm not muted. Sorry. Yeah. So thank you, Alice, and thank you also, Paul and Julian. It's always a challenge to speak third on these kind of panels, and particularly when the first two panelists have really covered the ground so well and made points that, you know, I don't particularly disagree with. So let me just try and pick out a few points that I think are important, and then we can maybe tee up some issues for further discussion as well. So, you know, I mean, the essay question, is there any money left? If you mean is any of the money we raise in taxes left over at the end of the fiscal year? Obviously, the answer is no. And the answer has been no for something like 44 out of the last 50 years. We very, very seldom run a budget surplus in this country. I think it's probably true of most countries. And that's interesting to think about and ponder the reasons why that might be and its implications. But it's not really the question that we're dealing with in this type of discussion. If you mean by is there any money left, can the government still borrow affordably? In that case, yeah, there's lots of money left. I mean, it seems like the government can borrow at the moment effectively unlimited amounts at long maturities and at very low interest rates. And that, as Julian rightly said, the fact that they can doesn't necessarily mean that they should. It's important to draw that distinction. Government spending isn't always a good or helpful thing, can be quite the opposite. And also it's right to worry, I think, a little bit about shifting the burden of our present expenditure onto future generations. However, when you're looking at an economy emerging from a pandemic and a deep recession, and the sort of the frailty, fragility of that recovery and the need to support it, to me, there's very little in current debt dynamics that would make you think that debt reduction, deficit reduction should be your immediate priority, right? I think the most important thing is making sure that we have a robust economic recovery, and that itself will deal with many of the other problems that might arise. Now, all of that obviously depends on government borrowing remaining very affordable, and it's right, I think, to note that that won't necessarily be the case. Interest rates could rise, but it depends why they rise, right? If interest rates rise because the economy is booming, and because, as Julian suggested, you need to pay investors more to get them to lend money to the government rather than investing in other productive business ideas. Well, actually, that doesn't really matter too much because, yes, your financing costs might go up, but also your tax revenues are going to go up. Your overall economy is going to be larger. The debt in that context is less of a problem anyway. The real danger, I think, is that you get strong inflation without strong growth alongside it, a sort of stagflation scenario. And if you had a situation where the economic recovery was very lackluster, but where inflation nevertheless started to take off and the Bank of England felt that it was sort of sustainable and they had to respond to it by raising interest rates, well, then in that scenario, you might have a problem. Now, I'm not convinced by any stretch of the imagination that is the scenario we're going to find ourselves in. It's quite weird for me, actually, to be so relaxed about the fiscal situation now when I spent years after the financial crisis giving doom and gloom speeches and media appearances about how terribly everything was going to go. I think I over-egged the pudding in terms of my pessimism then, and hopefully I'm not sort of correspondingly being too relaxed about everything now, because there are people whose opinions I respect, very bright people who think that inflation is going to be a genuine problem and that government financing costs might become tricky as a result of that. So worth bearing in mind, but again, I don't think the case is there to really prioritize debt and deficit reduction right now, as opposed to some of the other objectives that government might have. Let me make one final point, though, or a final couple of points. And the first part is that most of what I'm saying is kind of short term, so over the next 5 years, let's say. If you look at longer term projections for government spending and the state of the public finances, and the OBR has, and a good thing to look at is their 2018 Fiscal Sustainability Report, which really tries to take account of the impact of changing demographics, basically an aging population, on the government spending requirements. And we've known about this for so long that there are all kinds of unfunded liabilities, that an older population is going to require more healthcare, more social care, and so on. Well, actually, it doesn't take long over the next few decades before actually spending looks like it's going to get out of control on current policy assumptions. And actually, the sort of long-term deterioration, I think they look at things going out to sort of 2067, 68 or something. So quite a long way in the future. But when you look at the state of the debt and deficit and stuff that they're projecting that far into the future, it's actually such a bad picture that couldn't possibly happen. I don't think. Policy would have to change before you got there. But it's not clear how policy is going to change, or whether we've really done the thinking and the preparation we need, either on the tax side or on the spending side, to deal with that long-term impact of demographics on Britain's fiscal situation. So I think if you look far enough ahead, there may be a scenario where, okay, we're not going to be out of money, because governments don't really run out of money, as Julian said, but that actually we do have a very serious problem in terms of how do we afford all the things that we want government to pay for without having such high taxes that they strangle the economy that has to pay for everything. And so that I think is worth worrying about, but it's a long-term concern rather than a short-term one. And then just this final point, I'll make this very briefly, but economic growth to me is the overwhelmingly important part of all of this discussion. In a way, if the economy bounces back quickly, and if we can get it growing faster than it has since the financial crisis, if we can get productivity rising strongly at long last, then so many of these problems just go away. We can then afford to look after an aging population. Our debts and stuff won't get out of control. And so that to me is the key challenge. And so basically, just to sum up everything I've said, I'm fairly relaxed in the short term about whether there's any money left. I think we're fine, basically. There are things to look out for, but no immediate and overwhelming concerns. So don't prioritize the budget deficit, but do really prioritize growth. I think do everything you possibly can to make the economy larger and make it grow faster sustainably over the long run. That's really the solution to the problems that we have.
Thanks very much, Tom. I'm glad you talked about the financial crisis. That's where I started as well, because at the time, it felt like there was this very broad cross-party consensus that tackling the budget deficit was important. Austerity had the backing of the public. Now we're in a position where, you all seem to agree that luckily we don't have that same worry about reducing the budget deficit, but we're also in a very different position in terms of kind of public opinion. There's, I think now, strong backing for big public spending, particularly on fixing things like social care, clawing back some of the emergency spending is going to be very difficult for the government. So I was just wondering what the panel thinks about the sort of different political climate we're in now and what challenges that might present to the government. I don't know who wants to respond. Julian?
Yes, I'll have a first go. There's a lot in what you say. I think certainly the consensus amongst economists, if there ever is such a thing, has shifted. So in the early 2010s, there was a lot of support, including from international organizations like the International Monetary Fund, that austerity was the right thing to do. But since then, the climate has changed. I think there's a recognition that in particular, if all countries attempt austerity at the same time, that's doubly damaging. And if interest rates are already very low to begin with, one of the potential benefits of austerity is that interest rates fall further, but if they're already close to zero, there's not a lot of extra boost to the economy there. So I think the economics consensus has moved on, and I think it's certainly right not to be talking about austerity as a solution to the economic mess that we're in. But what worries me is that we seem to have gone a lot further, and the assumption seems to be that continued big government spending is the solution to all of our problems. And certainly, as you say, if you look at the opinion polls, there's lots of things that are very popular at the moment. Almost every form of spending is popular. 10% pay rises for nurses are very popular, without much thought for what that might cost and what the implications for the wider economy might be. I certainly do not think that policy should be based on opinion polls. A good example of this is the attitude towards corporation tax. Corporation tax increases are very popular because there's a perception that they hit big companies like Amazon and they bail out the high street. But we know that's not the case. We know that in practice, it's not companies that pay taxes, they're always passed on to real people. That might be rich shareholders, it might also be poor shareholders, but it'll certainly include customers and workers and so on. And what worries me is that often governments, including this one, tend to sort of work with the popular narrative rather than trying to correct it. So there's been a lot of talk about how it's fine to raise corporation tax because only big companies pay it, and we'll still have a relatively low rate of corporation tax compared to our competitors, which, by the way, is debatable if we include the less generous allowances that we'll have once the extra tax break over the next year or two rolls out. So I am concerned that if governments try and do what's popular, they're not necessarily doing what's right. And the role of the Chancellor in particular should be to push back against that, to say that these are realities of how public spending and taxation work. I think there was a hint of that in the budget. I mean, I don't personally think it was necessary to raise taxes, but I think in doing so, he was partly sending a signal to the general public and maybe to his spending colleagues to say that if you do continue spending at these current levels, there'll be a price to pay. But I am worried that, having ratcheted up spending as much as we've done over the last year, it's going to be very difficult to get that spending genie back in the bottle.
Tom, did you want to come back on anything there?
Yeah, sure. I mean, I think the issue of public opinion on spending, taxes, austerity, it's interesting because basically the public likes spending on people. Basically, the public wants spending on them and things that they like, and they like taxes on other people and things that they dislike. And what's more, actually, very strangely, I think. The whole idea of austerity seems to have been very effectively drummed into the population at large over the last 10 years, to the extent that I think, certainly in polls and focus groups, maybe more so, you find a significant amount of concern about debt and deficits and a sort of underlying belief that the government is out of money or they need to pay back their debts. And so while on specifics, there's sort of support for higher spending, and there's support for the taxes that won't raise all that much money. And if they do, they'll probably do it by hurting growth. And then on the other hand, a sort of desire to see the books balanced and everything. So if you're doing government by opinion poll, you won't have a very coherent set of policies, in my opinion, or at least you won't have a set of policies that steer the country in the right direction. And so it's very challenging if that's the way you want to go. I think, as Julian says, there has to be some sort of rational thinking about where we are and what we want to achieve, and then leadership rather than followership in terms of putting those policies before the general public.
Paul, you were saying that you were predicting that public spending would be considerably higher than the budget was saying.
Yeah, I think there's clearly a lot of pressures on it, both in the short and the long run. I mean, that's not. Some of that is, as you just heard. I mean, if you look decades out, or actually not even decades out, but a decade out, the pressures on health, pension, social care spending is going to be substantial. I mean, I think we are in for a state which is a bit bigger than we have got used to over the last many decades, actually, just because of the almost inevitable costs of an aging population. In the shorter run, as I say, there are also pressures from the scale of missed operations and waiting lists in the NHS, the scale of catch-up required in schools, the scale of catch-up required in the justice system, the pressures on local government. Now, those are, in the several billions, but those don't necessarily themselves make for a ratchet up in the size of the state. But I think all of that is a bit I think it's worth kind of separating off two sort of thoughts here. One is the sort of political thought, which I think is associated with the fact that over the last year, people have got used to the government being able to do everything and anything and whatever it takes. And I think there are big risks around that, because once you see that, under these circumstances, the government can spend an extra, whatever it is, £270 billion in a year, then the next time someone's asking for the odd £5 billion, how on earth do you say no? And I think that's going to be a really big problem for politicians, and particularly, as you heard, for chancellors in saying no. But I think that is something they're going to have to overcome, because for mostly you do have to say no. So that's one issue. And the second, which is a sort of structural issue, is this issue about how we deal with what are, I think, long run bigger pressures on the welfare state.
Thanks. I mean, yeah, this another big kind of issue that's changed our economic outlook is obviously Brexit, and perhaps we could talk a bit about how that's changed things, but also how much our recovery needs to be international, how much we're dependent on how other countries, how our trading partners recover from this crisis. Tom, thoughts?
Yeah, I mean, I think obviously the international economy will have an effect on how well we do. It always does. We're an open trading economy. But I mean, I think, look, all the conventional economic models will suggest that Brexit is going to have a sort of persistent hit on economic growth, that we will be somewhat poorer as a result of Brexit, and the less open trade with our closest neighbours than would otherwise have been the case. Now, I don't think that that's necessarily a foregone conclusion. I think that you can do things both in terms of trying to make that trading relationship as open as possible, and also trying to have freer trade with the rest of the world at the same time, and maybe also introducing other sort of pro-growth policies domestically, which maybe you could have done anyway as a member of the European Union, but maybe this gives you the sort of the impetus and the enthusiasm to actually do it. But yeah, it obviously it's not it's kind of unhelpful that we already had one sort of drag on the economy built into all of our assumptions, and then we've added sort of the most significant economic contraction since the Second World War or whatever on top of that. But yeah, I mean, I think that to the extent that the international side is important, in a way, we can't control how well other countries' economies do. What we can do is try and be as open as possible to the rest of the world. And one of the biggest impacts of free trade is actually making your domestic producers more productive, because you open them to more competition. People tend to see trade as all about, boosting your country's exports and sort of glory for the nation state and stuff. And that's good. But actually, the real long-run economic impact tends to be on your domestic economy, forcing you to focus in the areas where you have a comparative advantage, where you can be the most productive and produce the most growth. So to me, that's, when you think about the international angle, that's the most important thing, that we have to make good on the rhetoric of global Britain and genuinely be an open, free market, sort of pro-growth country. We can't take. I mean, I think this is always a caricature, but if you responded to Brexit by becoming a sort of Little England country in terms of your economic outlook, then I think that would pose a big economic drag, which would be doubly unhelpful in the current circumstances.
Could I suggest say a little bit extra on that as well? I'm probably the Brexit optimist on the panel. I mean, it's obviously true that there's been some initial disruption on the export side in particular, and I think anything that increases trade barriers with Europe is a bad thing and will remain a bad thing. But I suspect that the January numbers that we've just had will prove to be the worst, and from here on they'll get a bit better. There are other pieces of the jigsaw, though, that might be more positive, in particular that we have at least avoided no deal, and that had been a big drag on business confidence and therefore on business investment. So just as there's plenty of scope for consumer spending to bounce back over the next year or so, I think business investment will come back pretty quickly as well. And secondly, if we're thinking about where the growth is going to be over the next few years, I mean, it's clearly not going to be in Europe. I'd rather we didn't have an increase in trade barriers with Europe, but if we're going to have an increase in trade barriers anywhere, then Europe's probably the least damaging place because of how weak the economic outlook there is. It's more important for us to press ahead and lower trade barriers with faster growing parts of the world, including the US, partly because of the additional stimulus from the Biden plan there, and of course in the emerging world. And the final point, there is, of course, a debate about whether or not we would have diverged from the EU's vaccine program, even if we'd been a permanent and continued member of the EU. But I think it's no coincidence that we're the only country to have broken away from the EU's way of doing things. Even if you don't think the faster rollout of the vaccines is a benefit of Brexit, it does illustrate two things. One is the the benefit of a single nation state acting on its own, which I think is encouraging when it does come to us doing trade deals with countries further afield. And secondly, it shows the advantage of being more nimble and flexible on regulation. And we're seeing the problems at the moment with the AstraZeneca vaccine across Europe because of the strict adherence to the precautionary principle in so many EU countries. So even if the faster rollout of the vaccine isn't, strictly speaking, a positive of Brexit, it does illustrate some of the benefits that might be coming over the next few years. So yes, there's a short-term hit from Brexit, and there has been for a number of years because of the impact on uncertainty. But I think by the end of the year, we'll be starting to see the benefits offset those costs.
Paul.
I mean, I'm, if you're. We have, as Tom effectively said, made trading with our biggest, nearest and richest trading partner more expensive. And that's, that is going to have a continued and ongoing economic cost. There may be some offsetting benefits, but if there are, they're going to be smaller for a very considerable period of time. From an economic point of view, there are clearly other potential non-economic benefits. I think there are concerns in this sort of, because of that. I think the signal that's created by a big increase in corporation tax, for example, is probably not not ideal, shall we say, in a world in which, whatever the long run outcome from Brexit, clearly the short run risks and worries that businesses will have are real enough. And so I think what's particularly important in these circumstances is a very sort of strong, clear, stable institutional framework and a strong, clear, stable concern for a framework which is attractive to international businesses. And I think that a sort of economic strategy which is based on that is going to be particularly important, given the levels of risk and uncertainty that I think people will perceive associated with us, at least for a while, until things settle down.
Thanks very much. So I think we'll move on now to questions from the audience, and people watching, if you could put your questions in the Q&A rather than raising your hands, that'd be really helpful. So I think we'll start with a question here from Nick Salter. He says, is monetarism dead? Why doesn't massive government spending lead to massive inflation? I don't know who wants to.
I have a go? Yeah, no, I think it's a very good question. If you look at what's been happening to broad money growth, not just in the UK, but around the world, that is potentially a huge inflation signal. So I understand why people are concerned about this. It may be that the only reason we haven't already seen massive inflation is that, of course, people can't spend. So there's a limited number of things that you can spend your money on anyway. It's effectively being saved, and there has been a huge increase in household savings in aggregate. I know many millions of people had to dip into their savings, but by and large, most people have seen their incomes fall, but their spending fall even further. So there is potentially a sort of tidal wave of consumer spending just around the corner, and that could push up prices. That said, I'm still relatively optimistic, because I think to balance that potential wave of consumer spending, there's also, of course, an enormous amount of spare capacity. It might be somewhat less than otherwise because of the constraints of social distancing. So, restaurants, for example, won't be able to seat as many people at the same time as they would otherwise have done. But if we allow for the fact that there's probably 5 or 6 million people who are effectively unemployed but on furlough, we have massive unemployment in this country. It's going to be very hard to see a lot of wage pressure coming through. There are going to be lots of firms that have been kept going by emergency support during the pandemic that were desperate to restart. So I think what you will see is a big increase in demand, by and large matched by a big increase in supply. So we won't see massive inflation, but it's undoubtedly a risk. And as I say, if you look at what's been happening to the money supply over the last year or so, it's something you're going to be concerned about for some considerable period of time.
Paul, Tom, anything to add about inflation?
I haven't got a lot. I haven't got a lot to add to that. I mean, I think there are risks. It's very hard to determine how big they are. The Bank of England does still seem to be, I think, remarkably relaxed about this. But again, there are short-term risks and there are long-term risks, and there's a short-term risks associated not just with the large amount of money sloshing around, but also constraints in supply chains, both created by the pandemic and possibly by Brexit. And then there are longer term issues associated with demographic change and the longer term structure of the economy. I think this is, I think we're all, I suspect Tom will say much the same, as we don't really know what the scale of the risk is here, and it's something we just need to be very aware of, and the bank especially needs to be willing to respond quickly if it needs to.
Yeah, no, I pretty much agree, Alice. So we can move on to the next one.
All right. Here's a question from Dave Dempsey. He says, a considerable number of people are going to lose their jobs as their employers don't reopen, or their jobs will reopen and then fail. And their first reaction will be to look for similar jobs that may no longer exist. How disruptive will this be, and how long might it persist?
Shall I have first go again? If that's, yeah. I mean, I think in the short term, it's inevitable that unemployment will rise. I mean, as and when the lockdown is lifted and the furlough scheme is wound down, then clearly a lot of businesses that are being kept on life support now will inevitably fail. I think that is very regrettable, but sort of inevitable and almost sort of desirable. I'm always very wary of saying this, but it's a reality that there are always businesses that fail, and there might be a few more this time around because of the shock of the pandemic. But our labour market is relatively flexible. It is very good at creating new jobs to replace any that are lost. So we went into the pandemic with one of the lowest rates of unemployment in Europe, and actually we still have one of the lowest rates of unemployment in Europe. The government has been very successful in preventing massive job losses in the economy, considering the size of the fall in economic activity. So yes, there will be a period where unemployment rises, but I don't think it's going to rise very far. As I said earlier, unemployment now is about 5.1%. I think it's going to rise to about 6%, but no higher. I think we have to accept that's going to happen. I think the worst thing the government could do, for example, would be to extend the furlough scheme indefinitely, so that, apart from costing a lot of money, that would lock people into jobs that no longer be viable. It will prevent this sort of necessary adjustment of people moving from jobs that are not viable or unproductive into more productive parts of the economy. So I'm afraid we will have that period where unemployment is going to rise. During that period, I think rather than the government focusing on protecting jobs, I think it needs to focus on protecting incomes. So I think it was right, for example, to extend the universal credit and make sure that the welfare safety net is there to protect people who unfortunately do lose their jobs. But it's not the government's role to protect or create jobs once the market economy is getting back towards something like normal.
Yeah.
Paul, you're nodding there. Do you have a view on how the labour market might change post-pandemic and what sort of impact that might have on our recovery?
I broadly agree with what Julian said there. Again, in terms of anything more specific, one's inevitably getting into speculation. I mean, I think there might be significant transitions happening. I mean, depending on whether jobs move permanently from city centres into suburbs because office workers are going in less. For example, it may be that as a result of Brexit, some manufacturing industry will be affected. I think these are, that there are risks that some of this might come together, creating a sort of bigger impact, although the risks tend to be in different places. I mean, in terms of the labour market, it is important to be aware that, where are the most people on furlough and where have the most jobs been lost? Well, it's very much in London. I mean, much, much, much more in London than anywhere else in the country. And London does tend to, has got, at least up till now, a pretty dynamic economy, and one which hopefully will be able to adjust relatively quickly. I think in some ways more worrying would be impacts which were on some of the quote in quotes left behind areas, or those that are dependent on particularly big manufacturing plants and so on, because they're which may be an impact, a more localized impact from something like Brexit, and labour markets in those circumstances struggle much more to respond. And I suppose the last thing worth saying is that the sorts of jobs that up till now at least have been lost as a result of the pandemic have been the sort of entertainment, retail, hospitality type jobs, which are often the first rung on the ladder for people entering the labour market, either for the first time or after unemployment. So there may be a little more change that people have to get used to, and indeed sort of Job Centre Plus and employment advisors need to get used to, in the sense that we may be losing some of that first rung, and that will need to be replaced by something else.
Tom?
Yeah, I mean, just to say, I think it's interesting that when the pandemic first became serious, and when a lot of these economic support measures initially came into force, a big part of the justification was that you were kind of trying to freeze the structure of the private sector economy in place. You were trying to support everything as it stood in March 2020, so that when the pandemic ended and it was safe for everybody to go back to work and go out again, you could bounce right back. And that you would try and minimize as far as possible the economic scarring that would come with a traditional deep recession and large rise in unemployment. Now, obviously, the longer the pandemic has gone on for, the more likely it is that things will have significantly changed in some fundamental way when furlough ends and when people are expecting to go back to work and so on. And it's very hard to predict in advance, the precise extent of the impact that will have on unemployment. I'd probably fall maybe I'm a little less optimistic than Julian, but not in any way a massive pessimist. I think that a lot of the economy will just be able to bounce back when the restrictions are lifted. Inevitably, though, there will be some jobs which are no longer viable. But if you have an economy that's growing strongly and bouncing back effectively, then hopefully those workers can be reabsorbed elsewhere. But the truly important thing, I think, is if there have been fundamental shifts in patterns of economic activity, if people are moving out of town centre, if people are working from home, if people are having everything delivered rather than going to the shops, the government, if it's serious about growth and a competitive economy, it can't try and stand in the way. It can't try and protect the jobs of 2 years ago. It has to be serious about creating the jobs of 2 years from now. And so we just have to, unfortunately, for some people who will, I think, suffer as a result, embrace that dynamism.
Thanks very much. A quick question here from Gavin Rice, which I think it's something Paul touched on. Is the shape of the recovery likely to exacerbate pre-existing regional inequality, productivity and living standards in those left behind areas? And how sustainable is that politically? Paul, I don't know if you want to sort of pick that.
Well, as I say, I think the shape of the pandemic has not done that. There have been some very specific areas where it's affected that. So those sort of poorer areas that have been dependent on hospitality and entertainment, and some coastal areas. I mean, one thinks a place like Blackpool may have been affected particularly badly. If one's looking at a sort of big regional level, it really is London, head and shoulders above or below, depending on how you want to look at it, the rest of the country in terms of the impact on employment, at least, if not anything else. The shape of the recovery is very hard. As I say, it's very hard to predict what the shape of the recovery will be. Now, it could be, if we return very quickly to the same levels of hospitality, entertainment, and so on as we had beforehand, then it will, things will get back to, in June, when the economy is back to its pre-pandemic level. Maybe that will be distributed fairly much the same as it was pre-pandemic. But my guess is that it will at least take a while for that to happen in some sectors, in which case that will affect some regions more than others. And, I think the big unknown here and in my mind, I genuinely don't know, is the extent to which city centres recover as much as anywhere else. I can't think, if I'm honest, of a very good reason why why sort of England specifically, or the UK in 2 years' time, would be more regionally unequal than it was a year ago as a result of the pandemic. But it may be that I'm missing something there. But I can't think of a very good reason why that would be true as a result of the pandemic.
Julian, I mean, it's not just regional inequalities that the pandemic's kind of exacerbated. There's gender, race inequalities, generational difficulties as well. I don't know if you have any thoughts on how the recovery might.
This is enormously complicated. If we look at, for example, gender inequality, I mean, the most obvious gender inequality is that men are far more likely to die of COVID than women. So that the single most important issue, it's sort of shifted a gender bias in the opposite direction from which we normally see gender biases. A lot of the things that people have identified as sort of inequalities that have been exacerbated have typically been because, for example, young people are far more likely to work in areas like hospitality. So it appears that young people are being harder hit by the pandemic. And that's prompting some people to say that therefore we need to target unemployment support on young people. I think that's actually going a step too far. I think what you need to do is target unemployment support on perhaps in people who work in hospitality, regardless of their age. But there's clearly a tendency to look for, I hate to use the phrase, identity politics. I think sometimes you're missing the bigger picture. If you say that, for example, Black people might be more likely to be impacted by coronavirus, we must do something specifically for Black people. Whereas the reality is that Black people are more likely to be in certain types of job. And what we need to do is protect people in those jobs. It just so happens that a disproportionate number of people in those jobs might be Black. So I think there's a danger that in focusing on the identity politics of it, you miss what the underlying causes are. Now that's a bit sort of boring. It doesn't get the headlines in the same way. But I think there's a danger that in always looking for an inequality that's been exacerbated, you miss what the underlying causes of the undoubted economic and social problems are.
Tom, thoughts on that?
Well, I mean, I think, again, hard to predict in advance. There's a possibility, I think, that coming out of the pandemic, some of the trends that it's accelerated might drive a bit of leveling up. Certainly in a regional sense, if a lot of people suddenly realize, actually, no, we don't have to be paying very high rents and living in London to do this job. I can do it just as well from somewhere cheaper, somewhere where the quality of life suits me better, and so on. So it's possible that you might see a little bit of a decentralization. That has interesting implications, I think, for economic growth policy, because for a long time, one of the biggest drivers of economic growth has been agglomeration effects, and big cities in the UK, this basically just means London, are becoming more and more productive. Now, will that go into reverse in any way? And if so, what does that mean for how governments try and drive up economic growth rates here? I don't know the answer to that. I think it's interesting. You can also, I suppose, think about, you talked about, say, women, for example. If flexible and home working becomes much more common, does that actually diminish some of the the sort of gender pay gap and stuff, which tends to be driven by women having to take time out of the workforce for child rearing responsibilities and so on? The more flexible and the more you can work from home, do you eliminate at least some of that bias? So that's the optimistic take. The pessimistic one, of course, and I've heard people talk about a K-shaped recovery, which was a new one to me, but it was basically a recovery where you get very divergent paths for different sections of society. And maybe some people who have kept their jobs through the pandemic, they've saved up lots of money, their sectors haven't really been affected. For them, everything's great, and we sort of have boom years ahead. And for those who didn't have many savings, who've lost their jobs, maybe who the sectors they worked in will not have as many jobs in them in the future, they could have a sort of recovery from COVID, which is which is far less agreeable. All remains to be seen. I mean, I tend towards optimism on this, but it's going to be interesting to track how it all goes.
Thanks very much. Question here from James Hayward. The Chancellor cut departmental spending at spending review and took out another 4 billion in the budget. If these spending plans prove too optimistic, should he raise taxes even further, or should he be comfortable with an ongoing deficit on the current budget? Paul?
Well, I think it's important to stress that, at the moment, there's so much uncertainty, I think, about where, the deficit will be, either given this set of spending plans or a set of spending plans which are 10 or 15 billion higher, that I certainly don't think he should be announcing any further tax rises at the moment. My guess is that departmental spending in 2 years' time will be reasonably significantly higher than is currently planned, possibly of the order of 10 to 20 billion. So that's up to 1% of national income. So that's quite a substantial amount bigger than currently planned. Could be wrong about that, but I think it will be higher than currently planned. At that point, once we know where we are in terms of the size and growth path, at least more about where we are in terms of the size and growth path of the economy, it may be that we'll need some more tax rises over the medium run in order to ensure we do have something like current budget balance. I mean, in the end, if we have higher levels of spending over the long run, we will have to have higher levels of tax over the long run, which is a kind of boring sort of statement of the obvious. But I wouldn't, if I was a Chancellor, I wouldn't be announcing additional tax rises just yet.
Julian, thoughts?
I agree with almost all of that. I'm hopeful, of course, that over the longer run we will get better economic growth. In particular, we'll fix the productivity problems, and that we won't, in fact, need to raise taxes. We can afford to spend more money as a government, but that won't rise as a share of GDP because the economy will be bigger. I'd also just say that going into the crisis, even before the pandemic struck, the government spending was already about 40% of national income, which I would have said is more than enough to do the things that we probably all agree the government should be doing in terms of a decent welfare safety net and those sorts of infrastructure projects that perhaps the public sector can do better than the private sector. So I would try and push back against the idea that first of all, it's inevitable that public spending needs to be a lot higher than it was before the pandemic, but also that the only way to finance that is through higher tax rates rather than by getting the economy growing more quickly through a program of supply side reforms, deregulation, and so on.
Tom?
Yeah, I think that Paul is right. When you state it in those terms, it looks like, based on all the projections, spending is going to be higher as a percentage of GDP, and it looks like tax revenues are going to be consistently lower as a percentage of GDP. So eventually, taxes have to go up. I think the big problem, and I'm not saying I can necessarily agree with the conclusion there, but it's a very logical statement. I think the problem is politically, and when you think about public opinion and everything, if a government wants to raise taxes, it's very, very difficult for it to raise taxes in an economically sensible way. Now, for example, most economists would say that we'd be much better off with a broad-based VAT. At the moment, compared with almost every other developed country, we carve out huge swathes of spending from VAT with reduced rates, zero rates, exemptions, and so on. Now, I think, for example, if our VAT base was as broad as Switzerland's, that would raise about 75 billion a year, sort of right now and then on into the future as well. An economist broadly would say that's a sensible way of raising additional revenue. The public will say, absolutely not. This is the worst possible tax increase, and I'm going to protest about it, other than, say, trying the poll tax again. Generally speaking, the public supports tax increases, I said earlier, on other people and things it disapproves of. But you're never going to get all that much additional revenue from corporation tax without undermining growth, from capital gains tax without undermining growth, from sort of sector targeted things like a digital services tax or a bank levy and so on. And I think eventually something's got to give. My concern is you end up in a vicious cycle where you say, we're not raising enough money, our spending commitments are high, we need higher taxes. Which taxes can we raise? Okay, it's these ones that have public support, but oh, hold on, they undermine economic growth prospects. And far from fixing the problem, we end up making it worse and worse and worse. And we're chasing our tail. That, I think, is the danger. And as Julian said, the answer is getting the economy to grow faster. And you probably don't do that by increasing taxes on investment, just for example.
Well, I think it's probably about time to sort of round up, and if we can do that with one final question from me, which you kind of teed up there, Tom. So I think the one thing that you all seem to be agreed on is that growth is the best way out of this and essential for the recovery. So if you could make one policy change, one sort of pro-growth policy change, what would it be, Paul?
Oh, I hate those sorts of questions. Well, I mean, I think all pro-growth policies are really long run rather than short run. I think that's the most important thing. If I had to select one out of the multiplicity of things that really matter for that, I would be looking at education, and particularly post-16 education, and particularly post-16 education, which is not the academic route. So having much better, clearer, more effective apprenticeship and vocational and sub-university and sub-degree level routes where we have a terrible record relative to nearly every continental country, where you don't just get growth from that, you also get more social inclusion as well.
Julian?
Well, I'd slightly challenge the premise of the question, which is that it's the government that can act to boost growth. I'd love to see a chance to be really, really bold and do less rather than more. But if I was to say something I'd like to see the government do, it's to a fundamental review of the tax system, ideally including some quite chunky tax cuts, but at the very least some sort of meaningful simplification. A lot of the problems, for example, on the high street, we know are to do with the failing system of business rates. I think we need a fundamental review of all property taxes, ideally including getting rid of stamp duty permanently and altogether. But looking again at things like council tax and business rates, how they interact, and also trying to increase the regional element of all of this, giving more powers to local authorities to make decisions about spending and taxation in their areas. So a fundamental reform of the tax system would be my preferred choice.
Tom?
Yeah, well, I was involved in a big report on pro-growth tax reform last year, and if you Google UK tax reform, I think it will be the first result that comes up there. But tax is my thing, but because Julian already said it, actually the thing that I think would make the biggest difference to UK economic growth prospects would be massive liberalisation of the planning system, so that we can finally use our sort of ultimate scarce resource, land, in a more efficient way. More than anything else, I think that has the opportunity to make us more productive and a richer, more prosperous country.
Well, I think that's about all we have time for, but thanks everyone so much. That was a much more sort of optimistic and positive discussion than I was necessarily expecting. So thanks very much. And thanks everyone for watching, for your questions. Do sign up to the CPS and the CapEx newsletters, follow us on Twitter and Facebook, and tune in to future CPS events. Thanks.